to their rational wants. The second generation describes people as normal. It begins by acknowledging that the full range of people's normal wants and their benefits, utilitarian, expressive, and emotional, distinguishes normal wants from errors and offers guidance on using shortcuts and avoiding errors on the way to satisfying normal wants. People's normal wants, even more than their cognitive and emotional shortcuts and errors, underlie answers to important questions of finance, including saving and spending, portfolio construction, asset pricing, and market efficiency. These topics are presented in this book. We want more from our investments than the utilitarian benefits of wealth. We want the expressive and emotional benefits of hope for riches and freedom from the fear of poverty, nurturing our children and families, being true to our values, gaining high social status, playing games and winning, and more. The expressive and emotional benefits of playing investment games and winning attract billionaire investment professionals, just as they attract amateur day traders and the rest of us. Listen to John Paulson of the Paulson & Company Hedge Fund, known for the billions he made on mortgage-backed securities in the 2008 to 2009 financial crisis. Paulson, like many of his peers, does not intend to retire anytime soon, even although his wealth vastly exceeds what he can spend in many lifetimes. "I'm still relatively young, being 56, he said. "If you look at George Soros, he's 81, I think. Warren Buffett, he's 81. How old is Carl Icahn?" Paulson is clear about investing as a game, and candid about his wants for the expressive and emotional benefits of playing and winning. Some people like playing chess, some like backgammon. This is like a game, and playing games is fun. And he adds, it's more fun when you win. We often hear that behavioral finance is nothing more than a collection of stories about irrational people, misled by cognitive and emotional errors, that it lacks the unified structure of standard finance. Yet today's standard finance is no longer unified because wide cracks have opened between its theory and the evidence. This book offers behavioral finance as a unified structure that incorporates parts of standard finance, replaces others, and includes bridges between theory, evidence, and practice. Standard finance is built on 5 foundation blocks. 1. People are rational. 2. People construct portfolios as described by mean variance portfolio theory, whereby people's portfolio wants include only high expected returns and low risk. 3. People save and spend as described by the standard life cycle theory, whereby people find it easy to find and follow the right way to save and spend. 4. Expected returns of investments are accounted for by standard asset pricing theory, whereby differences in expected returns are determined only by differences in risk. 5. Markets are efficient, in the sense that prices equal values in them, and in the sense that they are hard to beat. Behavioral finance offers an alternative foundation block for each of the 5 foundation blocks of standard finance, incorporating knowledge about people's wants and their cognitive and emotional shortcuts and errors. According to behavioral finance, 1. People are normal. 2. People construct portfolios as described by behavioral portfolio theory, whereby people's portfolio wants extend beyond high expected returns and low risk, such as for social responsibility and social status. 3. People save and spend as described by behavioral life cycle theory, whereby impediments, such as weak self-control, make it difficult to find and follow the right way to save and spend. 4. Expected return.